This company just deliberately destroyed more than half its revenue, and the market still hasn't decided if that was genius or a mistake. Navitas Semiconductor, ticker NVTS, is trading around the high single digits as of recent levels. And today we're breaking down what the company actually does, why the story is changing, the bull case, the risks, and what the current setup is really implying. Quick reminder before we go any further, I'm not your financial advisor. This video is for educational and informational purposes only, and is not financial advice. Penny stocks and small caps are very risky and you can lose all your money, so always do your own research or talk to a licensed professional before making any decisions. At its core, Navitas is a power semiconductor company, but not the kind most people think about. They don't build the AI chips you hear about every day. They build the systems that deliver power to those chips. And that distinction is critical. Because as AI scales, compute is no longer the only constraint, power is becoming the limiting factor. Think of it like this: GPUs are the engines of AI, but without efficient power delivery, those engines can't run at full capacity. And right now, the traditional way of delivering that power is starting to show its age. Silicon, the material that has powered electronics for decades, struggles when pushed into high-power, high-frequency environments. It generates heat. It wastes energy. It requires bulky cooling. Navitas is betting on a different class of materials: gallium nitride and silicon carbide. These allow faster switching, higher efficiency, and smaller system designs. In simple terms, more power, less waste, less space. But here's where the story shifts. Navitas isn't just improving existing systems, they're trying to redesign how power flows inside AI infrastructure from the ground up. And that's a much bigger bet. But here's the problem. To make that bet, they had to walk away from their past. Historically, a large portion of Navitas' revenue came from mobile fast chargers, a massive market, but one with intense competition and thin margins. So, management made a decision most companies avoid. They exited a large part of that business. And the impact was immediate. Revenue fell sharply year over year, reflecting the company's deliberate shift away from lower-quality legacy business. That's not a gradual transition. That's a hard reset. And this is where the narrative splits. To some investors, that looks like collapse. To others, it looks like discipline. And this is the part most people overlook. Even as revenue fell sharply, gross margins held roughly steady in the high 30% range, which suggests something important. The business that remains is higher quality, less volume, but better economics. Less exposure to commoditized markets, more exposure to strategic ones, and that leads us into the bull case. First, AI infrastructure. Navitas is positioning itself in the power layer of data centers, specifically the shift toward 800-volt DC architectures. At a major industry conference, they unveiled a system that converts power directly from 800 volts down to usable levels in a single step. That eliminates an entire conversion stage. Now that might sound like an engineering detail. It's not. Every step in power conversion introduces losses. Remove one stage, and you improve efficiency, reduce heat, and simplify the system. In large-scale data centers, those gains compound quickly. We're talking about lower operating costs, higher rack density, and better performance under load. Their system reportedly achieves around 96.5% efficiency at high switching frequencies. And in an environment where power demand is exploding, efficiency becomes a competitive advantage. But here's where it gets more interesting. Navitas isn't just targeting one part of the system. They're trying to play across the entire grid GPU power chain, from high-voltage grid conversion using silicon carbide, to low-voltage delivery using gallium nitride. That full-stack positioning is rare for a company of this size. Second, the pipeline. Navitas has built a design win pipeline of roughly $450 million. And this is where investors need to be careful. Pipeline is not revenue, but it does signal future intent from customers. It tells you that large players are at least testing or integrating their technology. And if even a portion of that pipeline converts, the revenue profile could change quickly. Third, supply chain strategy. Navitas is working to localize part of its manufacturing in the United States, including production in Vermont through a major foundry partner. That matters more than it used to. Because geopolitical risk is now part of the semiconductor equation. Customers, especially large ones, want supply chain resilience, and Navitas is positioning itself to offer that. Fourth, the balance sheet. The company holds over $200 million in cash, giving it runway to execute this transition without immediate pressure. That doesn't eliminate risk, but it buys time. Time to scale. Time to prove the model. On paper, that's a strong setup. But markets don't reward potential alone. They reward delivery. If you're getting value from this breakdown, tap like and subscribe to Penny Stock Pulse. It really helps the channel and tells me to keep making these deep dives for you. Now let's talk about the risks. Because this is where the story becomes less comfortable. First, the revenue gap. Even if the decline was intentional, the company is now operating at much lower revenue levels, roughly in the single-digit millions per quarter. That creates a visibility problem. Investors don't just want a future story, they want to see momentum. And right now, that momentum is still forming. Second, profitability. Navitas is not consistently profitable. They are investing into growth, which means losses are part of the equation for now. But the longer that continues without revenue scaling, the harder the story becomes to defend. And this is where the timeline matters. Because transitions don't get infinite patience from the market. Third, competition. Navitas is competing against much larger semiconductor players, companies with deeper pockets, broader product portfolios, and established customer relationships. Even if Navitas has strong technology, scaling that advantage is not guaranteed. And this is the part most retail investors underestimate. Winning in semiconductors isn't just about innovation. It's about manufacturing, reliability, and long-term trust. Fourth, stock dynamics. Navitas has a high level of short interest, over 27% of the float, at one point. That creates a very reactive stock. Positive news can drive sharp rallies. But negative developments can accelerate downside just as quickly. And here's the key risk to focus on. If Navitas does not show clear, sequential revenue growth over the next 12 to 18 months, the entire transition narrative starts to weaken, because at that point, the question becomes simple. Was this a strategic pivot or a premature exit from a stable revenue base? Now let's zoom out to valuation and price context. At current levels in the high single digits, the stock is well below previous peaks. But it's still not cheap in a traditional sense. Because valuation here is not based on current earnings. It's based on future expectations. At one point, the price-to-sales ratio reached extremely elevated levels, reflecting belief in long-term growth. So what is the market pricing in today? It's pricing in execution. It's assuming that the design pipeline converts into real revenue. AI infrastructure demand continues to accelerate, and Navitas captures a meaningful share of that shift. If those assumptions hold, the current price could represent early positioning. If they don't, the downside comes from expectation resetting. And this is where the chart context matters. The stock has shown significant volatility, with key support forming around the $8 range. That level acts as a kind of line in the sand. Hold above it, and the narrative remains intact. Break below it, and sentiment likely shifts more bearish. So this becomes less about technical indicators, and more about whether the story continues to gain credibility. So who is this actually for? This is not a low-risk, steady under. This is a transition story. It likely appeals to investors with a longer time horizon who believe in the shift from silicon to wide bandgap materials, investors who are comfortable with volatility, and investors who understand that execution, not just technology, will determine the outcome. Because at the end of the day, this is not just a company story, it's a timing story. A question of whether they can scale fast enough to match the opportunity. And transitions like this are rarely smooth. Final thoughts. The bull case is straightforward. Navitas is positioning itself at the center of the AI power bottleneck with differentiated technology and a growing pipeline. The bear case is just as clear. Revenue has dropped sharply, profitability is still uncertain, and execution risk is high. What matters next is simple. Can they convert potential into real, growing revenue over the next few quarters? If they can, the story strengthens. If they can't, the market will adjust quickly. If you found this deep dive helpful, hit like, subscribe to Penny Stock Pulse, and turn on notifications so you don't miss the next under the radar breakdown. Thanks for watching, and I'll see you in the next video.